you ready? Are you ready? Are you ready? Let's go.
Welcome to Unpacking the Home Advantage. My podcast here is to help you understand the mortgage loan side through my experience and knowledge. My name is Paige Ashby. Now, if you have been following me, thank you and welcome back. And if you're new, I hope you enjoy this information. Today, we're going to talk about bankruptcy and foreclosure rules in the lending world. Don't let bankruptcy and foreclosure scare you off from getting a loan. Things happen. Let's go over all the rules. Let's get unpacking. The first thing we're going to talk about is bankruptcy rules. In regards to a FHA and a VA loan, which are government loans, the bankruptcy 7 has to be 2 years out from the discharge date. Now, to get this discharge date, there should be a discharge letter that's mailed to you when you're done with your bankruptcy, or the discharge date will be listed on your credit report. Usually it's the bottom of the report and it'll have the exact discharge date when your bankruptcy 7 has been done. Now, in regards to bankruptcy 13, there's a little bit more rules to that. Must document the following. 1 year of the payout period under the bankruptcy has elapsed. Number 2, all payments have to be made on time when you're in the bankruptcy 13. Number 3, you have to have a written letter permission from the court to enter into the mortgage that you're doing, the mortgage transaction. So when you're not completely out of the bankruptcy 13, you will have to get a written permission letter. And it's pretty simple. The borrower has to submit this to the trustee and the court, and they will approve it based on what the need to do the transaction, either a purchase or a refinance. Now, on the conventional side, the bankruptcy 7, it must be 4 years out from the discharge date. Now, that's on a Fannie Mae. On the Freddie Mac, it can be 3 years out. So I've gotten approvals on Freddie Mac before, right when it hits 3 years. So those are doable if you are doing the Freddie Mac instead of Fannie Mae. Now, for the Chapter 13, the dismissal date must be 4 years out. Now, as you can see, the conventional rules on the bankruptcy is a little bit harder. Now, let's go through the foreclosure guidelines. With FHA rules, if you've had a foreclosure, it has to be 3 years out. There's a 3-year waiting period from the trustee's deed. So the time it is sold, so when you pull up a deed that your house has sold, they go by that date, 3 years out. On the VA rules, there is a 2-year wait period from the trustee's deed date. So when you pull up the deed, they will go by that date. It doesn't matter what other dates are listed on your paperwork. On the lending side, they will go through and see when the sold date is, and that's the period that it will go out to. Now, conventional, again, it's going to be a little harder. For foreclosure, there is a 7-year wait period from the sold date of the property, not from the date of missed payments. It will be the sold date, which is, again, on the deed. Now, these rules can adjust a little bit with each lender and program, so you might want to check with your loan officer because these change all the time. But these are the main basic rules for bankruptcy and foreclosures. So now, if you don't fall into these rules, there is a last resort, which I've done many of these loans to, help you get out of your situation for at least 10 to 12 months so you don't lose your house. As you know, you have equity. You don't want to just lose it, give it to the lender. What I do, a lot of these loans to get people out of their situation to keep their house, is called a hard money lender. Now, it's not like the old ways of hard money where they just take your house, they just charge you whatever they want. The rate is 30%. They cannot do that. The hard money lender that I have is very reasonable, and that is the last resort. There's no prepayment penalty, so you can get out of it whenever you want. Usually my clients obviously take some time to get their credit better or takes time for the late payment. So it's about 10 to 12 months. But you can get out of it. You can sell it. You can move, whatever you choose to do. So there's no prepayment penalty. Now, the hard money lender is not so crazy to do because the rate is about the same as the non-QM loans, which is the bank statements. Now, I've talked about the bank statement programs in my other episodes, so it's not that crazy. So this is a worst case scenario, but it helps you save your house. It helps you get out of your situation. And make sure when you do look for a hard money lender, make sure you do your research, make sure it's a recommendation, because obviously there's a lot of fraud going on, so you have to be careful. But I'm in Colorado and I have a great hard money lender that has been in the business for 30 years, and we have a great relationship. So definitely do your research on who you do business with. It's pretty crucial these days. Look them up, look up their license, and referrals are the best word of mouth recommendations. Anyways, this is a short episode, but I hope you have some basic information on bankruptcy and foreclosures. If you have any questions, let me know. If you have enjoyed this information, please make sure to give me a follow. And if you know of anyone that may benefit from this, please share. More episodes to come. As an active mortgage broker and mentor, if you have any questions, you can reach out to me through LinkedIn, Paige Ashby Lending. And my other contacts are listed below my episodes. Thanks for being part of Unpacking the Home Advantage.